Chapter 11, Part 5, PP&E and Goodwill Impairment under GAAP and the International Standard. Now, property, plant, and equipment are subject to depreciation, depletion, and amortization, but intangible assets with indefinite lives are not subject to amortization, but they are looked at for impairment. Now, when you're looking at assets that have finite lives, we use this test. We use the recoverability test. We determine if the undiscounted expected future net cash flows are less than the carrying amount. If no, there is no impairment. If yes, we go to test 2. Then we're going to compare the fair market value to the carrying value to determine impairment loss. Assets held for usage. You determine new depreciation rate but cannot restore impairment if you depreciate it. Asset held for sale. You stop depreciating it and then you can restore the impairment loss up to the net book value at the time of the impairment write-down. So now let's take a look at a problem. Ronald Company uses special equipment. The equipment was purchased in 2020 for $10 million, had an estimated life of 8 years, no salvage value. At 2021, new technology was introduced, and it accelerated the obsolescence of this equipment. The controller estimates that the undiscounted future cash flows are $6.3 million, and the fair value is $5.6 million. They intend to continue using the equipment, but they're saying it only has a useful life of 4 years left, and they use straight line. So, we know what we paid for it. We know how long we're going to use it. We know what the future net cash flows are. We know what the fair value is. And we know how many years it is now. So now what we can do is take a look and come up with our impairment entry. So we're going to do our first test. Cost. First we're going to come up with net book value. And then we're going to compare that to the future cash flows. And since it's greater, that means we have to go to test 2. Then we're going to compare the net book value to the fair value, and it tells us we have an impairment loss of $1.9 million. Now, this is what is on the books, but what we have to do when we have an impairment is we have to write down the asset to the fair value and remove the accumulated depreciation and book the loss. So, the entry we'd have to make for these two accounts is we'd have to decrease equipment by $4.4 million. And we'd have to get rid of the accumulated depreciation, and so now we have 5.6 on the books, which is the fair value. So the journal entry would look like this. We would book the impairment loss, and we would adjust accumulated depreciation and equipment. Record depreciation expense. If they continued to use the equipment, it would be depreciation expense and accumulated depreciation. The fair value of the equipment is determined to be $7.9 million. If the equipment continues to be used, it cannot be adjusted to fair market value under GAAP, so no journal entry is required. What if the equipment had not been used? So, first of all, you got to remember, we can write it up, but not to the total amount, only to the net book value at the time of the write-down. So we could write it up by $1.9 million, and we would debit accumulated depreciation and credit recovery of loss from impairment. Now, what does this look like under the international standard? Net book value. We'd look at the undiscounted cash flows versus the net present value of future cash flows. And then we have the fair value less cost to sell. So we're going to determine impairment. We're going to compare the net book value to the higher of the net present value versus the fair value. And in this case, we use the $6.1 million, which tells us we have an impairment loss of $1.4 million. If the asset value increases, you are able to write up even if depreciated under the international standard. Now we're going to take a look at goodwill. Now, goodwill is an intangible asset. Unlike other assets, its cost can't be directly associated with any specific identifiable right and is not separable from the company as a whole. Impairment of goodwill can't be measured in the same way as other assets. Level of testing is the reporting unit. A reporting unit is an operating segment of a company or a component of an operating segment for which discrete financial information is available. And segment management regularly reviews the operating results of that component. Now, I just want you to know, in the new textbook, what they say is if a company is privately held, then what they can do, instead of doing this, they can just write it off over 10 years. And I think what they're trying to do is do that for all corporations, not just privately held. And just so you know, that's the way they used to handle goodwill. They didn't do assessment tests. They just amortized it over 10 years. It used to be 15 years. Now they're saying 10 years. Because it's very difficult to do this kind of an assessment that they're asking you to do right now. Now, goodwill impairment under GAAP, tested annually and more frequently if events or changes in circumstance indicate that it's more likely than not that the asset is impaired. The test. If the book value exceeds fair value, an impairment loss is recognized for the difference. There is no recoverability test. If an impairment loss is recognized, the write-down book value becomes the new cost base for future cost allocations. So let's take a look at a problem. Now, a company paid $500 million for a company that included $100 million in goodwill. At the end of 2021, the following information was provided. The fair value of the net assets are $355. The fair value of the net assets excluding goodwill are $320, and the book value of the net assets including goodwill are $380. The fair value is the same as the selling price less cost, and the present value of the future cash flows is $360. Now we need that so we can look at this versus how it's treated with IGAAP. So we'll look at that problem. That's the information we're going to work with. Now here's how we do our test. Step 1. A goodwill impairment loss is indicated when the fair value of the reporting unit is less than its book value. Fair value of $355 is less than the book value of $380, so there is an impairment. Step 2. A goodwill impairment loss is measured as the excess of the book value of the goodwill over its implied fair value. Now, how do you get that? Well, you determine the impairment. You take the fair value of the net assets and you subtract that from the fair value of the net assets excluding goodwill. And in this case, they're saying that goodwill is implied to be worth $35 million. Now, I want you to know when you do this, you can't write up any of the other assets. We're only looking at goodwill when we do this. Now, we subtract what's on the books, and according to this, we have an impairment write-down of $65 million. And that would be our journal entry, and that would be part of other. Now, this same problem, what does it look like under the international standard? Step 1. Under the international standard, the impairment loss is the difference between book value and the recoverable amount of the cash generated. Recoverable amount equals higher of the fair value less cost to sell and present value of future cash flows. So the book value, including goodwill, is $380 million. The higher of the net present value versus the present value less selling expenses, so we use the $360. So when we use the international standard, we're only going to write off $20 million. So that's a big difference. And that concludes Chapter 11.